Hello, everyone. This is the second video of Chapter 8. And from the last video, you remember that we have been discussing the investment evaluation criteria or investment evaluation technique. In the last video, I talked about net present value and payback rule. And in this video, I'm going to talk about average accounting return. So this is another attractive but flawed approach in making capital budgeting decisions. Okay, sometimes it's also called accounting rate of return. There are many different definitions of accounting rate of return. However, they are mostly express the same meaning or same outcome. Okay, so you can see that average accounting return is calculated as average net income divided by average book value. Okay, so average net income divided by average book value, which is average accounting return. And you know that book value calculation depends on how an asset is depreciated. Okay. And it also requires a target cutoff rate. So companies usually will have a certain rate of return that a company wants to earn. So on a project, so it could be a required rate of return. And if the accounting rate of return that we calculate, let's say we calculate an accounting rate of return which is 10%, and the target required rate of return is 15%. Okay, in that case, this project will be rejected. Okay, because its accounting rate of return is less than the target rate. On the other hand, if we calculate average accounting return of a project and it is higher than the target rate of cutoff rate, then the project will be accepted. Okay. So look at this example. The required investment to fit out the shop is 500,000. So you need to invest 500,000 in a project. The store would have a 4-year life. The required investment would be 100% depreciated over 4 years. Okay, that means this 500,000 would be depreciated over 4 years. And the profit for the year. So you see the profit are 40,000, 50,000, 60,000, and 70,000. Okay, so you remember our formula was average net income divided by average book value. So this is the profit every year, and we take the average of the profit. So average of the profit is $55,000. Okay, and average book value. Okay, now what is the average book value? Average book value is the beginning book value plus ending book value divided by 2. Now, beginning book value is 500,000 because that's what you are investing now, and it will be completely depreciated over 5 years period. So at the end of the project, end of 4 year, the book value of the project will be 0. So beginning book value plus ending book value divided by 2 is the average book value, right? So average profit 55,000 divided by average book value, we see that average rate of return, average accounting rate of return or average rate of return is 22%. Okay. And as I said, that it will be compared with a cutoff rate. And let's say that cutoff rate for this project is 20%. And since this rate of return is higher than the cutoff rate, this project will be accepted. On the other hand, if the cutoff rate is, for example, 25%, and as this average rate of return is less than that, the project would have been rejected. Okay. Now, advantages and disadvantages. And once again, you see that it's easy to calculate. So you have profits, you have the book values, you just calculate them. You just calculate the average and calculate the ratios. And these informations are also easily available because profit, book value, those are easily or publicly available information in most cases. Okay. So let's talk about the disadvantages. You should recognize the chief drawback of this approach immediately. Above all else, this average accounting return is not a rate of return in any meaningful economic sense. right? It's not a rate of return. Instead, it is the ratio of two accounting numbers. Okay, so one is the profit, another is the book value. So you use these two numbers to calculate a ratio. So it's essentially is a ratio. It's not a return in a true sense. That's why it's not comparable to the returns offered in let's say in a financial market, or if you have an alternative investment and there is a return, it is not comparable because it's not essentially a return conceptually. Okay. One of the reasons that ARR is not a true rate of return because it does not consider or it ignores time value of money. Okay, you remember we have profit, we just take the average of the profit. So it does not consider time value of money. Okay, when we average figures that occur at different times, we are treating the near future and more distant future in the same way. Right? If you have a 10-year project, since you are averaging the cash flow in year, so profit in year 1 and profit in year 10, they are getting the same weights. Okay, so no discounting involved. As a result, it does not consider the time value of money. Okay. The second problem is similar to the problem of the payback period, that it has an arbitrary benchmark cutoff. Well, like for payback, we also discussed that payback has an arbitrary cutoff. So it also has an arbitrary cutoff rate. Since a calculated AAR is really not comparable to a market return, the target AAR must somehow be specified. Okay, and there is no generally agreed way to do that. Now, how you come up with this arbitrary cutoff rate, there is no consensus on how you can do that. One way of doing is to calculate the AAR for the firm as a whole and use it as a benchmark. Okay, however, there are lots of other ways to do that, and management will arbitrarily take one of these approaches. Third, and perhaps the worst flaw in the AR is that it does not even look at the right things. Okay, instead of cash flow and market value, it uses profit for the year and book value. Okay, you remember for net present value, we looked at the cash flows and we discounted them. But in this case, we relied on not cash flow, we relied on profit. Okay, and we also did not consider market value, rather we used book values, and these are poor substitutes. As a result, an AAR does not tell us what the effect on share price will be from making an investment. Okay, so it does not tell us what we really want to know. So we want to know that whether a project will be adding value to the company and whether it contributes to shareholders' value maximization principle or not. So it actually does not tell us that. Okay, so these are the advantages and disadvantages of the average accounting return. Okay, so that's the end of this video. In the next video, we will talk about another investment decision criteria, which is internal rate of return or IRR. Okay, thank you very much.